The most profitable customers of the largest banks in America are not the wealthy. They are not the investors. They are the ones who can least afford to be profitable. Every time a family in Ohio carries a balance on groceries, every time a nurse in Texas pays the minimum on a credit card bill, every time a young couple in Florida uses plastic to cover an emergency room visit, they didn't plan for. They are not just borrowing money. They are feeding a machine designed in boardrooms, refined over decades, and optimized to extract maximum value from the precise moment when you have the least leverage. There is a quiet trap built into the American financial system, and it has nothing to do with the interest rate you see on your monthly statement. It has to do with how the game was rigged before you ever sat down to play. By the end of this, you will understand how credit cards became the most profitable product in modern banking history. You will see the hidden mechanics that turn a plastic rectangle into a wealth transfer device, moving money from the paycheck of the many to the portfolio of the few. You will learn why the average American now carries over $6,000 in credit card debt, why delinquency rates have hit their highest level in nearly a decade, and why the system is designed to keep you in what the industry politely calls revolving. This matters right now because the squeeze you feel is not an accident. It is the logical outcome of a system engineered to profit from friction, from delay, from the gap between what you earn and what you need to survive. Let's start with the numbers, because numbers don't lie, but they also don't tell the whole story unless you know where to look. Americans now owe $1.28 trillion on their credit cards. That is trillion with a T. In the fourth quarter of 2025 alone, balances rose by $44 billion. The average credit card APR hovers above 22%. To put that in perspective, if you carry a $5,000 balance and make only minimum payments, you will pay more than $11,000 in interest over nearly 18 years before the card is paid off. The bank will have collected more than double what you originally borrowed, and you will have spent almost 2 decades tethered to that debt. But here is where the story gets interesting. Not everyone is trapped. In fact, the system depends on a stark divide. The Federal Reserve Bank of New York recently confirmed what economists call a K-shaped economy. On one branch of the K, the affluent glide upward. Their investment portfolios swell, their home equity grows, and they pay off their credit cards in full each month, collecting rewards points and cash back as a bonus for their liquidity. On the other branch, the majority struggle upward, and increasingly they don't. They carry balances. They pay interest. They become what the industry calls revolvers. And revolvers are the engine that makes the whole machine hum. To understand why, you have to look at who gets paid when you swipe. Every time you use a credit card, the merchant pays a fee. It's called the merchant discount rate, and it typically ranges from 1.5% to 3.5% of the transaction. That fee gets split among multiple players: the issuing bank, the payment network like Visa or MasterCard, the merchant's bank, and the processor. The issuing bank takes the largest slice, the interchange fee, which can be $14 to $16 on a $1,000 transaction. That interchange fee is the bank's reward for extending you credit, for handling billing and fraud risk, and for funding your rewards program. Now here is where the incentives get misaligned. Banks make money in 2 ways from credit cards. One is from the interchange fees on transactions, which they love from customers who pay in full. Those customers generate revenue without risk. But the real money, the deep money, comes from the second stream: interest. If you carry a balance, the bank collects not just interchange fees, but also compounding interest at rates that would make a loan shark blush. And because credit card debt is unsecured, meaning the bank can't repossess your groceries if you default, those high rates are priced to cover losses from the borrowers who can't pay. But here's the uncomfortable truth the industry doesn't advertise. The losses are not evenly distributed. They are concentrated among the most vulnerable. And the banks have gotten extraordinarily good at predicting exactly who will pay and who won't, and pricing their products accordingly. The result is a system that looks like a flat rate but functions like a personalized toll booth. If you have excellent credit, you might qualify for a card with a 12% APR and generous rewards. If your credit is middling, you might face 25% with fewer perks. And if your credit is poor, you might not qualify for a traditional card at all, pushing you towards subprime products with fees so layered that the interest rate almost becomes secondary. This system was not always the law of the land. To understand how we got here, we have to go back to 1978. That year, the Supreme Court decided a case called Marquette National Bank versus First of Omaha Service Corporation. The question was simple. When a bank in Nebraska issues a credit card to a customer in Minnesota, which state's interest rate limits apply? The court ruled unanimously that the bank could charge the rate allowed in its home state. Nebraska had no usury cap. Overnight, the careful architecture of state-level consumer protection, built over generations, crumbled. 2 years later, Citibank did something that would reshape American finance. It announced it would relocate its credit card operations from New York to South Dakota. South Dakota had just eliminated its usury ceiling specifically to attract banking jobs. Other banks followed. Delaware joined the race to the bottom, passing laws that invited card issuers to incorporate within its borders and export their rates nationwide. By 2003, nearly 3/4 of all credit card loans in the United States originated from just 2 states, South Dakota and Delaware, holding barely 4% of the country's population. A handful of state legislatures, captured by banking interests, set the terms for the entire nation. This was the moment the trap snapped shut. Before Marquette, credit was local. A borrower in Chicago negotiated with a banker in Chicago, both operating under Illinois law. After Marquette, credit became deracinated. The relationship was no longer between neighbor and neighbor, but between a family in Cleveland and a corporation legally headquartered in Sioux Falls, governed by rules written in a state capital hundreds of miles away, where that family had no vote, no representation, and no recourse. Fast forward to today. The system has evolved, but the logic remains the same. A recent report from DVS01, a loan-level data analytics platform, shows that the share of credit card spending by super prime borrowers, those with credit scores above 780, has climbed to 83%. That is up from 70% before the Great Recession. Meanwhile, the bottom 80% of earners are barely keeping up with inflation. Their spending has essentially flatlined when adjusted for rising prices. They are not the ones driving economic growth. They are the ones servicing debt. Mark Zondi, chief economist at Moody's Analytics, put it bluntly. The top 10% of earners now account for nearly half of all consumer spending. If they stop, the economy stalls. But the bottom 90%? They are treading water, and some are drowning. Delinquency rates have jumped to their highest level since 2017. More than 4.8% of outstanding household debt is now in some stage of default. And it's not just credit cards. Auto loans, mortgages, home equity lines are all showing strain, particularly in lower income areas. The Fed's own research confirms what many families already feel. The economy is not one economy, it is two. And if you are on the wrong side of the K, your credit card is not a convenience. It is a lifeline, extended at terms you cannot negotiate, attached to rates you cannot escape, provided by a bank you cannot reach. Recently, President Trump proposed capping credit card interest rates at 10% for 1 year. The idea has populist appeal. Who wouldn't want to slash rates that routinely exceed 20%? Bernie Sanders and Josh Hawley introduced a bill with the same goal. A Vanderbilt University study estimated that such a cap could have saved Americans nearly $100 billion in 2024 alone. But here is where the incentives tell a different story. The banking industry warns that a rate cap would trigger a credit freeze. JP Morgan's CFO said people would lose access to credit on a very, very extensive and broad basis. The Bank Policy Institute estimated that 14.3 million families could be cut off entirely. Bill Ackman called the idea a mistake, warning that it would push borrowers toward loan sharks. And William Stern, a fintech CEO, made the most incisive point. If you cap the price, you don't make credit cheaper. You make it unavailable. Banks will not lend at a loss. They will simply stop lending to anyone who looks remotely risky. The uncomfortable math is this. 22% APR is not arbitrary. It is the price of lending to a population where some will default. If you cap the rate at 10%, the banks don't absorb the loss. They exit the market. They raise fees. They eliminate rewards. They demand higher credit scores. The people who need credit most, the ones with thin files, variable income, imperfect history, get pushed out of the formal system and into the shadows. The trap doesn't disappear. It just changes shape. So what is actually happening beneath the headlines? The quiet reality is that credit cards have become a form of regressive taxation. They take disproportionately from those who have least, and they redistribute upward to shareholders, to executives, to the affluent who play the rewards game and win. The 60% of cardholders who carry balances are effectively subsidizing the 40% who don't. The cashback and airline miles that wealthier consumers enjoy are paid for by the interest and fees extracted from those who can't pay in full. This is not a conspiracy. It is a designed system. Banks have spent decades refining their risk models, segmenting customers with precision, and structuring products to maximize extraction. They know exactly who will revolve and who will transact. They know which zip codes generate profit and which generate losses. They know that the minimum payment is a trap dressed as mercy. And they know that as long as the overall economy holds, the losses from the bottom will be dwarfed by the interest from the middle. Zoom out, and the implications are stark. A society where a third of families cannot pay their bills on time, where 60% carry credit card debt month to month, where delinquency rates climb even as the stock market hits records, that society is not stable. It is brittle. It is one shock away from fracture. And that brittleness has consequences far beyond household budgets. Geopolitically, a nation whose middle class is drowning in debt is a nation with limited strategic bandwidth. It cannot invest in the future because it is servicing the past. It cannot tolerate disruption because it has no buffer. It cannot project confidence because it has no reserves. The same system that enriched a few states and a few banks has, over 4 decades, quietly hollowed out the financial resilience of the many. And that hollowing is now visible in the data, in the delinquency reports, in the rising balances, in the exhausted faces of families who work harder than ever and fall further behind. Which brings us to the question no one in Washington wants to ask. What happens when the trap springs? What happens when the K-shape becomes a canyon, when the revolvers can no longer revolve, when the minimum payment exceeds the monthly budget? The banks will write off the debt. The losses will be socialized or securitized or somehow absorbed. But the families will carry something else, the weight of a system that promised convenience and delivered dependency. A system that marketed freedom and engineered friction. A system that, for millions of Americans, turned the simple act of buying groceries into a decade-long financial sentence. If this perspective changed how you see the plastic in your wallet, like the video and subscribe. We break down the hidden systems that shape our world, from the boardroom to your bank statement, without ideology, without moralizing, just the facts of how power actually works. In the comments, tell us, when did you first realize your credit card was more than just a payment method?